Ahoy there, trader. Are we ready to rally higher? The data suggests it does, but let's go and look at the charts. So before we take a look at the indexes, let's just fire up the algo and let's look at the data. The data quite literally says that we shouldn't worry. If we carry on buying the dips and selling rallies, we've got a multi-decade back test that can quite literally prove and validate and verify that on average over the long term it makes money. So that's what I'm going to carry on doing. As always, the hardest part about sitting through these deeper retracements or corrections, as we're now in, is living through it in real time. Now when we look at the charts, we are quite literally just at the 200 period moving average. Looking left across the chart, we can see that we've been here before. This was the last time that we were at a critical point. Again, looking left at the charts, we can see that prices stopped here previously. So we've almost got this expanding triangle type pattern. This is more of a discretionary observation, but nonetheless it's just letting me know that we're not really out of context for the last 6 to 8 months. We can also see this on the Dow. This has been more prominently developing over most of last year coming into this year. We've got this rising highs and a very clear and obvious base here, and we're not really doing anything new. So although we are below the 200 period moving average, which is a usual critical level that most big institutional traders will pay attention to, from a price point of view, we're not really doing anything new. So we're not really, certainly I'm not worried until we move below 33,000 on the Dow. Let's take a quick look at the VIX. The VIX is a measure of volatility. It has an inverse relationship to the S&P. And one of the things that I'm looking for, well, firstly, we've got the big COVID spike there in volatility. Let's just take that off the chart. We're not really evaluating that today. But what we have is when the markets do something weird and crazy, volatility increases. We looked at the previous retracement or sell-off in December on the chart, and we can see that that got to about 35. So we're not really any higher than we were back at the end of last year. So for me, I'm going to be eyeing 40 on the VIX. So if we go above 40 on the VIX, we go below the recent lows that we've seen on the index charts. Now that in itself might not be a big deal. It's when we multiply that with a catalyst. I'm not really seeing anything that is new and noteworthy in the news for the moment, and obviously that can change. But until there's a catalyst, we're not going to be looking at a stock market crash. There's nothing to worry about, and I've got to say yet, because obviously, you know, what comes tomorrow can change. But that's what I'm looking for. VIX above 40, new lows on the stock market combined with a catalyst. That's when it's we'll be looking at a March 2020 repeat occurrence. Until that happens, this is just a corrective move. Volatility is increasing. It's not going any higher than 35. And again, until it does, it's not really anything to worry about. Now, the market can move lower. The other scenario, the markets can move lower. But as long as VIX doesn't go above 40, then I'm not going to be looking at this in any other way than a corrective move. Until then, I'll be looking to buy the dip, essentially. I'll be looking for dip buying opportunities. I've got a universe of stocks and a watch list that have some excellent candidates, and you'll probably see some of those videos posted if you subscribe to the YouTube video over the coming days and weeks. With that said, I'll see you on the next installment.